I'm going to begin this conversation with you. What do you make of what Bob was talking about right there, the bounce yesterday? Do you believe that we did hit a bottom in the market? If so, what do we do from here?
I think we're going to bounce around these levels right now. I think the market's still trying to digest all this information, or as we've been thinking about it, it's been an everything, everywhere, all at once type of situation where between trade policy, immigration policy, and the geopolitical outlook, investors are really not sure where to turn. And so I think we're going to bounce around these levels. We could see it going down a little bit lower, but I think it'll start to get its feet underneath it as we get earnings coming out for the first quarter.
Patrick, same question for you. How do you see this market? Do you believe we may have hit a bottom, or at least a short-term bottom right now? Of course, there's a lot of headline risk in this market from the administration, and also a lot of concerns about inflation.
The question is may, and it's definitely we may have hit a bottom, but it's going to be dependent on Trump's policies from here. A lot of us have been expecting that Trump's trade tariffs, trade wars were opening gambits to create some leverage for a future negotiation. He's been pushing back against that belief. If he does continue to push back and we do get into a trade war, I think there is another leg down in this market, because that creates a stagflationary environment that's toxic for equities, toxic for bonds. My view is still he's trying to create leverage, trying to get good trade deals in place. But for that leverage to be effective, the rhetoric has to be believable. And I think that's the point we're at right now.
You know, Patrick, that's a very interesting point. Certainly a lot of concerns about both recession and stagflation. But I do want to ask you, what could not be priced into this market? I mean, we know the president, I've often said he's mercurial. He seems to change his mind about things. And also he has people in his administration that put out and float ideas that sometimes he confirms and doesn't confirm. Isn't that uncertainty already priced into this market? What do you think could move us a leg lower?
Exactly. Uncertainty is priced right now, and the economy and the stock market is built on confidence. Confidence, you know what rules you're going to play by. When you put the U.S., Mexico, Canada free trade, that was a 10-year deal that was put in place, and now that seems to be pulled back, so the automakers don't know where they're going to invest their capital. And confidence is key, and right now, that's what it is. It's a crisis of confidence on uncertainty, but the leg down would be driven by policy that really has teeth. So right now, people are worried about that policy potentially coming into place. That's hurting confidence. If it is put in place, I think there's real economic impacts that would create another leg down.
All right, so Alan, coming back over to you right now, you're saying right now investors are looking for de-risked portfolios. I got to ask you, what's de-risked right now in this environment? It seems like every part of the market is being hit by this uncertainty and also the tariff concerns and the inflation concerns.
I think the best way to play it has been the ability to allocate to fixed income. What we've seen year to date is that investors have been moving out of equities into fixed income, and we think that's going to continue. And really the opportunity here is that you're clipping a coupon now that 3-4 years ago you didn't have. And other than that, I think within equities, I think utilizing healthcare, I think having comm services, which has held up relatively well compared to tech, will also get you there, as well as utilities. And the bottom line for us is that markets are going to go up and down like this. You should expect this type of volatility. It just feels really tough at the time.
Wait. Alan, you should expect this type of volatility? I mean, $1 trillion wiped out in one day. And if you're someone who's expecting it, then how do you play it? How do you take advantage of the volatility? Because, of course, when some people are losing money, there are other people who are making money and winning.
Well, you're spot on, Frank. And the reality is, if you look back over 100 years, you should expect a 10% downdraft once a year and 3-5% downdrafts each year and a 20% downdraft every 3 years. So this is normal, if you will, quote unquote normal for the markets, but it doesn't feel great at the time. And so I think as you look at your portfolio, being diversified is the key component of that. So as you're feeling the downdraft in consumer discretionary, as you're seeing some of the pain come through in tech, you still have holdings in utilities, you have holdings in the financials and in energy that are a ballast, if you will, and then also utilization of international developed from a full diversification perspective, as well as fixed income.
All right, Alan, we got to get going, but I want to ask you, we're talking utilities and energy. Is that a dividend play, or do you think those sectors rebound in this upcoming year after kind of underperforming last year?
I think the utilities are one that are going to continue to do well. They're more of a growth story for the first time in probably my entire career. And on the energy front, I think we're going to continue to see WTI stabilize. I think you get the dividend play while also waiting for growth to stabilize.